Imagine waking up at 2:13 in the morning to the sound of glass breaking downstairs. Your heart starts racing. You grab your phone. You hear your wife whisper, "Did someone break in?" And within seconds, your entire life changes. Not because of the intruder, but because of what happened after. The police come. The damage is documented. Your back door is destroyed. Your electronics are gone. Your jewelry is missing. And by sunrise, you realize something terrifying. Your insurance policy barely covers any of it. The adjuster tells you, "Unfortunately, this isn't included under your current protection." And just like that, a single missing checkbox on an insurance form costs your family $43,000. That happened to someone I know personally. And the worst part? They thought they were protected. That's the dangerous illusion most people live with. Because when people hear the word insurance, they think they're safe. But being insured and being properly protected are two completely different things. And most families don't discover the difference until it's too late. Now this matters because we're entering one of the most financially fragile periods in recent history. Home repair costs are exploding. Medical bills are rising faster than wages. Natural disasters are becoming more expensive. And one emergency can erase years of savings almost overnight. Here's what history shows. Financial collapse rarely begins with luxury spending. It usually starts with one unexpected event. A flood, a lawsuit, a medical emergency, a disability, a house fire, a car accident. One moment, one form, one overlooked detail. And suddenly people who looked financially stable are drowning in debt. But here's the real problem. Most people shop for insurance the same way they shop for phone chargers. They just want the cheapest option. They compare monthly payments. They skip the details. They assume all policies work the same. And they never ask what's actually excluded. Insurance companies know this. That's why policies are often designed to feel reassuring, while quietly limiting payouts in the situations that matter most. Because insurance is a business of probabilities, and the less informed you are, the more profitable you become. Now, before we go deeper, let's clarify something important. This is not about fear-mongering. This is about financial survival. The goal of insurance is not to make you rich. The goal is to prevent one crisis from permanently destroying your future. And the specific policy that saved that family $43,000? It wasn't some exotic investment product. It wasn't a luxury upgrade. It wasn't expensive. In fact, most people actively decline it because nobody explains what it actually does. And this is where most people get it wrong. They think the biggest financial threat is losing income. It's not. The biggest threat is a sudden expense large enough to wipe out everything you've already built. That's why the wealthiest people in the world obsess over risk management. Not because they're paranoid, because they understand one timeless truth. Protecting money is more important than making money. A person who earns $100,000 but loses $200,000 in one crisis is not financially secure. They're financially exposed. And today, we're going to break down the exact insurance protection most families ignore, why it matters more than ever, the psychological trap that causes people to skip it, and how one small adjustment could literally save your future. Because once you understand this, you'll never look at insurance the same way again. Let's start with the mistake almost everyone makes. Most people assume their standard policies fully protect them. They don't. Homeowners insurance has limits. Auto insurance has limits. Health insurance has limits. Even disability coverage often has gaps people never notice. And those gaps only become visible during disaster. Think about that psychologically for a second. Insurance is one of the only products people buy hoping they never use. So emotionally, people don't want to think deeply about it. They want the discomfort to disappear quickly, which creates the perfect environment for bad decisions. The average person spends more time researching a television than reviewing their liability coverage. That sounds insane, but it's true. And insurance companies understand human behavior extremely well. They know most people will focus on the monthly premium instead of catastrophic risk. So they compete on price, not protection. Now here's where the story gets serious. The family that lost $43,000 had homeowners insurance. Technically, they were insured. But after a severe water backup flooded their basement, they discovered something devastating. Their policy excluded sewer backup damage. The repair costs were enormous. Flooring destroyed, furniture ruined, electrical damage, mold remediation, temporary relocation expenses, and almost none of it was covered. Why? Because they had skipped an optional rider that would have cost less than $15 a month. $15. That tiny decision turned into a $43,000 nightmare. And this is not rare. According to multiple insurance industry reports, one of the most common reasons claims are denied is because policyholders assume something is covered when it isn't. That assumption gap destroys families financially. Now this matters because modern life is becoming increasingly fragile. Homes are more expensive, cars are more computerized, healthcare is more costly, extreme weather is increasing, and lawsuits are larger than ever, meaning the cost of being underinsured keeps rising every single year. But here's something even more dangerous. Most people believe disasters happen to other people. Psychologists call this optimism bias. It's the same mental trap that makes people ignore retirement planning, emergency funds, and health screenings. Humans naturally underestimate future risk, especially if they've never experienced catastrophe before. But financial disasters don't announce themselves. Nobody wakes up expecting their ceiling to collapse. Nobody expects to get sued after a car accident. Nobody expects a tree to destroy half their roof. Nobody expects a hospital stay to cost more than a luxury vacation. And yet, these things happen every day. Now let's talk about the specific insurance protection many experts quietly consider one of the most important financial safety nets in America: umbrella insurance. And if you've never heard of it, that's exactly the problem. Because despite the name, it has nothing to do with weather. Umbrella insurance is extra liability protection that activates when the limits of your existing policies are exceeded. In simple terms, it protects you from catastrophic financial lawsuits. Here's an example. Imagine you're involved in a serious car accident. The other driver suffers major injuries. Medical bills pile up. They sue you. Your auto policy covers up to a certain amount, but the lawsuit exceeds that limit. Without umbrella coverage, you could personally owe the difference. That means your savings, your investments, even future income could be at risk. Now pause for a second and think about how terrifying that actually is. One accident, one bad moment, and years of financial progress could vanish. But with umbrella insurance, that additional layer can cover the excess damages, which is why many financially educated families consider it non-negotiable. And yet most middle-class households don't have it. Why? Because people think umbrella insurance is only for millionaires. That's outdated thinking. In today's economy, ordinary people can face massive liability risks, especially with rising medical costs and legal settlements. A serious injury claim can easily reach hundreds of thousands, or even millions, even if you're not wealthy. And here's the twist most people never realize. You don't need to be rich to get sued. You just need to be involved. Now this matters because social media and modern culture have dramatically increased litigation awareness. People sue more aggressively today than they did decades ago. And insurance companies themselves have reported rising claim severity across multiple categories, meaning payouts are getting larger. But there's another reason this conversation matters. Inflation. Inflation silently destroys old coverage assumptions. A policy amount that seemed huge 10 years ago may be dangerously inadequate today. For example, a roof replacement that once cost $12,000 might now cost $25,000 or more, depending on the area. Vehicle repairs have exploded because modern cars contain sensors, cameras, computers, and advanced safety systems. Even a minor collision can now cost thousands. And this is where most people get it wrong again. They think, I've never had a problem before. But insurance isn't about your past. It's about your exposure. That's like saying, I've never had a house fire before, so smoke detectors are unnecessary. The entire point is protection against low-frequency, high-impact events. Now let's go deeper into why people consistently skip critical coverage. There are 3 psychological reasons. First, normalcy bias. People assume tomorrow will look like yesterday, so they under-prepare. Second, price anchoring. They obsess over monthly costs instead of catastrophic outcomes. Saving $20 monthly feels emotionally rewarding until a $50,000 bill arrives. Third, complexity avoidance. Insurance documents are confusing, so most people mentally surrender and trust assumptions instead of verifying details. And that surrender becomes expensive. Here's what financially resilient people do differently. They ask one powerful question. What's the worst-case scenario this policy does not cover? That single question changes everything. Because now you're looking for blind spots instead of reassurance. And blind spots are where financial disasters hide. Now let's talk about another policy millions underestimate. Disability insurance. Not life insurance, disability insurance. And statistically, you are far more likely to become temporarily disabled during your working years than to die early. But almost nobody talks about this. Why? Because disability feels uncomfortable to imagine. People don't want to picture themselves unable to work. But here's the real problem. Most households are income-dependent machines. If income stops, the entire structure begins collapsing. Mortgage payments continue. Utilities continue. Debt continues. Food expenses continue. Life keeps billing you even when you can't work. Now imagine recovering from surgery while watching your savings evaporate month after month. That stress alone can destroy families emotionally. And historically, financial strain has been one of the leading contributors to relationship breakdown. Money problems don't just affect bank accounts, they affect mental health, marriages, sleep, parenting, and long-term stability. That's why protection matters so much. Not because it's exciting, because it preserves peace during chaos. Now here's an interesting historical example. After Hurricane Katrina, thousands of families discovered that flood damage and water damage were often treated differently under insurance policies. Many assumed they were covered. They weren't. The financial devastation lasted years for some households. And similar patterns happened after major wildfires in California. People discovered replacement costs had risen beyond their coverage limits. Again, not because they had no insurance, because they had incomplete protection. That distinction matters enormously. Now let's discuss something most people completely ignore: deductibles. A low premium often means higher out-of-pocket exposure, and companies know consumers emotionally prefer smaller monthly numbers. But during emergencies, those deductibles suddenly become very real. Imagine facing a $10,000 deductible during a medical or home crisis. Could your emergency fund handle it? Most Americans would struggle. And this is where emergency savings and insurance work together. Insurance reduces catastrophic risk. Emergency funds absorb immediate shocks. You need both. One without the other creates vulnerability. Now here's another dangerous trend happening right now. More people are underinsuring assets because inflation has increased premiums. To save money, they reduce coverage. That feels logical in the short term, but financially, it can become catastrophic, especially if replacement costs continue rising. This creates a hidden national risk nobody talks about enough. People believe they're protected until disaster exposes the gap. And psychologically, that betrayal feels devastating. Because insurance is built on trust. When people discover their assumptions were wrong, the emotional damage can be almost as painful as the financial loss. Now let's talk about how financially smart households approach protection differently. They think in layers. Layer 1. Emergency savings. Layer 2. Proper core insurance. Layer 3. Catastrophic protection like umbrella coverage. Layer 4. Asset diversification and long-term planning. This layered approach dramatically increases resilience. And resilience is the real goal. Not appearing rich, not impressing strangers online, not financing luxury lifestyles you can barely afford. Real financial security means one bad month does not destroy your life. That's true wealth. Now here's a modern example that shocked a lot of people. During the pandemic, millions discovered how financially exposed they truly were. Businesses shut down. Jobs disappeared. Medical uncertainty exploded. And households with weak safety systems entered panic mode almost immediately. Meanwhile, financially prepared families still suffered, but they had breathing room. That breathing room changes everything psychologically, because panic creates terrible decisions. People liquidate investments too early. They accumulate high-interest debt. They ignore long-term consequences because survival stress takes over. Protection buys clarity, and clarity protects decision-making. That's why wealthy people often appear calmer during crises. It's not luck. It's preparation. Now let's address one of the biggest misconceptions in personal finance. People think wealth is built only through investing aggressively. But historically, avoiding catastrophic losses has been equally important. A portfolio growing at 8% annually means very little if one uninsured disaster wipes out decades of progress. That's why risk management is foundational. And this is where most financial influencers fail people. They obsess over income hacks and investment returns, while ignoring protection systems. But you can't build lasting wealth on a fragile foundation. Now here's a simple framework you can use immediately. The next time you review any insurance policy, ask these 5 questions. What specifically is excluded? What are the payout limits? How have inflation and rising costs affected my current coverage? What catastrophic scenario could still financially destroy me? And if disaster happened tomorrow, would I actually understand my policy under stress? Those questions expose reality fast. Now let's talk about something emotionally important. Many people avoid reviewing insurance because they associate it with fear. But preparation is not fear. Preparation is responsibility. There's a massive psychological difference. Fear says, I'm doomed. Preparation says, if something happens, my family won't collapse. That mindset shift matters, especially for parents. Because whether people realize it or not, insurance is often an invisible act of love. It's future protection for people you care about. The person paying extra for proper coverage isn't wasting money. They're buying stability. They're buying recovery time. They're buying protection against irreversible financial damage. And when disaster finally arrives, those decisions suddenly become priceless. Now this is where the story comes full circle. The family that lost $43,000 eventually recovered financially. But the emotional stress lasted much longer. The arguments, the anxiety, the sleepless nights, the feeling of betrayal. All because of one overlooked detail nobody explained properly. And after everything happened, the father said something that stuck with me. He said, I spent years trying to save money, without realizing I was exposing my family to far bigger losses. That sentence explains modern financial life perfectly. People focus intensely on small expenses, while ignoring massive hidden risks. They'll spend hours trying to save $10 on streaming services, while remaining financially vulnerable to 6-figure disasters. And this is where true financial maturity begins. When you stop asking, what's the cheapest option? And start asking, what protects my future? Because cheap insurance becomes very expensive the moment catastrophe strikes. Now, before we finish, here's one final insight most people never hear. The goal of insurance is not maximizing payouts. The goal is preserving continuity. Keeping your life functioning after impact. Keeping your family stable. Keeping your finances alive. Keeping one disaster from becoming permanent ruin. That's the game. And the people who understand this early usually avoid the worst financial outcomes later. So here's the action rule. This week, review every major insurance policy you have. Not emotionally, not casually, seriously. Look for exclusions. Check liability limits. Review deductibles. Ask about inflation adjustments. And understand exactly what catastrophic scenarios remain uncovered. Especially umbrella insurance. Especially disability coverage. Especially hidden exclusions. Because the best time to discover gaps is before disaster happens, not after. And if this video made you rethink how financial protection actually works, let me know in the comments. What's one insurance detail you discovered too late? Or one financial lesson your family learned the hard way? And if you want more videos that break down the hidden financial risks most people ignore, from debt traps to economic survival strategies to wealth protection systems, subscribe now. Because in today's economy, making money is important, but protecting it is survival.